Trade uncertainty has returned to the markets with the U.S. Supreme Court ruling against some of the Trump administration tariffs and Washington responding by slapping a fresh round of levies on global imports. Joining us now to discuss what it all means for investors is Kevin Hebner, Global Investment Strategist with TD Epoch. Kevin, great to have you back on the program.
Hey, Greg.
Always develop. Every time we meet with each other, it's like there's so many more things to talk about. Let's talk about the developments over the past couple of days with tariffs. What's the big takeaway for investors?
The big takeaway is the Supreme Court gave Trump a timeout. So he likes to tariff by tweet. And so the Supreme Court has said, well, you can't do that for a few months. You're going to have to do all these investigations. You're going to have to get some public comments and then use different laws. And then you can go back to tweeting the way you've been and putting tariffs on countries sort of at whim. But at least for the next 150 days, Trump can't do that.
So this 10% that he, in reaction to the developments on Friday, first was going to be 10% over the weekend. He upped it to 15%.
Yeah.
Is this not tariff by tweet? What's the mechanism for here to start putting those in play?
Yeah, so the piece of legislation he's using now, it suggests there's a balance of payments crisis. And the law says that you can do that up to 15% for up to 150 days. So it's an easy thing to do, and that's what he went. It's similar to what Nixon did back in '71. So that's easy for him to do. And then there's a number of other pieces of legislation that he's been referring to, but you have a number of hoops you have to jump through before you put those in place. Those would involve investigations into countries like China or Japan that he has problems with, or particular sectors, semiconductors, critical minerals. They have to do investigations. And these can all be done well within 6 months, so within the 150 days. So the USTR, the United States Trade Rep, that department's going to be really busy. There's going to be teams of economists producing these reports. I think they'll be using a lot of AI to do this. And you can come out with a report in a month. You have a 1-month comment period. You write up, you address some of those comments, and then that gives Trump the basis for the next round of tariffs. So I think ultimately, in July, when the 150 days are up, we'll be back to where we were last week. But in the interim, as you were mentioning before, there is a bit of uncertainty. But what we've been saying now for a year and a half, the baseline is 10% universal tariffs, a bit higher on China, and then a bit here and there depending upon Trump's whim.
Okay, so we take this back to the U.S. dollar. This has been an interesting one for a lot of investors trying to figure out if the dollar has. There's discussions I was having before the decision came down. Has the dollar bottomed? What does it mean for gold? What does it mean for other investments? With this new round of sort of tariff uncertainty, what's your view on the book?
So we think the dollar is going to weaken through the end of Trump 2.0 by another 10 to 15%. So it's already weakened by 8 to 10%. And the reasons for that, one would be AI hype is sort of coming off the boil. A second reason would be the Fed Treasury partnership, which becomes real in May. That means, for example, we'll get lower interest rates. It means funky things happening with US dollar swap lines that the Fed offers to other central banks. So other countries want to diversify away from the dollar because Trump increasingly is weaponizing access to the dollar. And so as we continue through, and also the fiscal issues that the U.S. is facing, these are not going to be getting any better. At some point, we'll have financial repression or fiscal dominance. Yeah, this chart is a good one. This shows net interest payments. And you can see that from the years going out, this is going to the moon. And it's really hard to see anything that's going to decrease that going forward. We have a report coming out outlining some of these issues, but it's a really tough one.
So from the look of that chart, it looks like the Americans and the Trump administration want a lower dollar, need a lower dollar.
Yeah, so to reindustrialize, they need a lower dollar. So reindustrialize for semiconductors, critical minerals, a host of different sectors, including sectors of the futures, like robotics, drones, autonomous vehicles. They absolutely need lower US dollar. At the same time, they want the dollar lower without the yield curve shifting up. And that's the real challenge, especially when you have this sort of move. And Trump has talked openly in the last couple of weeks about so-called financial repression measures, policies that the U.S. government can put in place to keep the yield curve stable and maybe even shift it in a bit.
What are the ramifications here for investors? I think sometimes people think about an administration that wants to force a lower dollar. They start thinking, perhaps we're wired as human beings to think about the negative consequences.
Yeah.
Let's look at some of the potential negatives, but maybe some of the potential positives here.
Yeah, so the positives there are a number of things that tend to do well when the US dollar declines, because a weaker dollar means looser financial conditions globally. And that's because a lot of countries, a lot of companies abroad issue US dollar debt. A weaker dollar means repaying that debt is easier. So you have easier financial conditions because of the US dollar, and also because the Fed's going to be cutting this year. So it's a good environment in terms of liquidity. But in particular for the dollar, a weaker dollar, as this chart shows, is 88% correlated with the relative performance of emerging markets. You get a similar correlation for EFA, which means markets like Europe and Japan, also highly correlated. And then at the sector level, sectors like cyclical sectors, materials, industrials, energy, tend to do really well with a weaker dollar. So this fits in with our broadening out theme. So people have had very concentrated bets in US tech. It's important to diversify beyond tech into other sectors, some of the cyclical sectors we're mentioning, and beyond the United States into global champions in the UK, Europe, Japan, China, and so on.
With this dynamic of play, I know you're looking at the idea that the U.S. will no longer be the banker to the world.
Yeah.
What's the investment implications for that?
Yeah, and so I think this is pretty important. So the U.S. is stepping back from its three big roles: policeman to the world, consumer of last resort, and banker of the world. So U.S. clearly is setting back from these things, and it means every country out there, including Canada, is being quite aggressive in terms of increase in defense spending and industrial policy. Canada really hasn't had industrial policies since the 70s with the National Energy Program under Marc Lalonde and Pierre Trudeau. So this is important in every country. And in Canada, we think it's quite constructive. Increase in defense spending, industrial policy, some fiscal stimulus, which makes us positive on Canadian assets, Canadian equities, and the Canadian dollar.
When someone takes a look at the markets today, and I mean, we're down more than a percent in New York. Day to day, we can't say much, but it does make people nervous about, policy uncertainty. You just said constructive for Canada. An investor pulls back, looks with a bit of a midterm, longer term lens. How should they be thinking about all this? Yeah,
so this chart looks at hedging, and that's a good point, because a year ago, the exposure for overseas investors, and certainly Canadian investors, to US dollar assets was a record high, and their hedging ratio were record lows. Typically, hedge ratios are 50 to 60%. They were down to 10 to 20. Now we're back way up, say, to half of where we should be. So Canadian-based investors need to be thinking a lot about the US dollar exposure and to be hedging it. And as the Fed cuts, we think by 75 to 100 basis points this year, we don't see the Bank of Canada doing a whole lot. That means the hedging costs for Canadian-based investors become pretty de minimis, maybe 50 basis points.